Welcome back, everybody, to another episode of Built to Scale. And today's guest is John Bencosme. I had to get that right, John. Sorry. So we're going to keep rolling with that. I screwed up his name earlier and we cut that out. So John Bencosme. And John is an expert in ESOPs and personally passionate about ESOPs. And so for our guest today, we're going to be diving into the topic of ESOPs, that this is very relevant. I see amongst construction companies that when I go to all kinds of trade shows and conferences, John, that I am hearing the discussion of ESOPs come up so frequently. And for our audience, John has a background as a construction CFO as well. And so the breadth of experience, he comes as both a previous construction CFO, as well as he's an ESOP advisor with ESOP One. Just that breadth of experience and what he's going to bring to the table to today's conversation. And this is actually going to be a episode one of a two-part series with John particularly. We actually are going to plan more episodes about ESOPs, but today we're going to go into the pros of ESOPs, and next episode will be on the cons of ESOPs. And this is actually a topic that two episodes does not do justice on ESOPs. That there is a lot of nuance to this, but it's becoming such a significant theme in the construction community that felt like it was absolutely worth it to deep dive, that this could be an exit strategy for a lot of business owners to consider. It could be a strategy, right? And I want to emphasize that we're going to dive into what are the pros and the cons, and ultimately business owners can decide, is this really the move that they want to make? And so really appreciate having you on the show, John.
No, glad to be here. Love so look forward to our conversation.
What else would you love to share with the audience about yourself that, what should they know as some of the key highlights of John?
Yeah, so no, my background is as a CFO in probably the last 15, 20 years in construction, real estate development, in subcontractor space, and kind of working with all size of companies from a $1 million to $500 million, um, contractors and GCs, and so kind of stumbled into the ESOP space about a decade ago and been kind of headlong in it.
Yeah, perfect. So and this is what I love about being able to talk to you today, John, that the relevance of your practical experience in the operations of actual construction companies, but your personal passion, and that you've been doing some ESOP advising and very familiar with setting up ESOPs. And so just love, because I personally, I I have a personal opinion. That's gonna probably come out on these episodes about ESOPs. I think that there's a lot of advisors that you get a lot of the picture of the pros of them. And I think it's important to have a neutral discussion. And so I just so much appreciate, because you get a lot of investment bankers that come and sell ESOPs, but it's like, yeah, but they sell them, implement them, and then they're out the door. And on the other hand, you have actually implemented them and stayed inside the company. And so I love your practical experience that you're going to bring to the table of this conversation, or these conversations. So tell me first and for our audience, what makes you so passionate about ESOPs personally? Would love to hear your perspective on this.
Yeah, we kind of, like I said, I stumbled into the ESOP space and mostly driven by trying to find tax advantage. So, a lot of my background is doing very high end residential, these multi-million dollar, multi-year homes. And there's kind of a curse in that, because tax wise, you can defer all your profit for years, and you got this ticking time bomb of taxes, which is kind of what we found ourselves in. And we just knew there had to be a better solution. And we looked at 1,000 different options. And once I got a real understanding of what's out there in the ESOP space, it just from a tax efficiency, I don't know if there's a better solution. So that's kind of where I stumbled into it. And then I think as you start to have the live experience, you start to see if it's done well, a boatload of other benefits in terms of performance, retention, cash flow. So quite a bit of the pros. So I'll see if I can convert you here by the end of the call.
Fair enough. Fair enough. And I mean, that's the thing is, right. That's why I wanted to make this and bring you in and the dynamic of this conversation. I also have experience, not so much of ESOP advising, but being inside an ESOP as well as you do. And so, we're going to come at this at unique angles of it. So I love that perspective, because even you and I talked about it, that And I think a lot of construction business owners are looking at ESOPs from a legacy building standpoint or a legacy continuation standpoint. I loved it on a previous call when we were kind of, prepping for this podcast discussion that said, yeah, that there's two major pieces to it: altruistic and tax, right? And there's a significant tax consideration about this that I I'd love for you to kind of deep dive on that further because you emphasize that what are the tax considerations of this, that what should business owners be thinking about when they're considering ESOP? Like, what are the tax savings that could be gained from it?
Yeah, yeah, and I think maybe one step back in terms of the reason to do an ESOP. I think will then kind of feed into the tax advantages of it. So you're and I think as part of the reason I think ESOPs are so popular in construction, it's a challenging business to sell because they're typically driven by one strong leader, one or two strong leaders, and they are the business. So you can't really technically sell yourself, and unless you've got already a pre-built succession plan, an internal person that's going to buy you out, which is not typical, right? Folks working their way up the construction management career track aren't sitting on significant cash to buy you out. You're kind of you got the option of either your kids are taking over, right? Your internal hire, or you go to private equity. But honestly, private equity is going to the reason those guys make a lot of money. They're going to squeeze you for the best deal that works for their investors, and it comes with its own pros and cons of kind of being owned by private equity. And I think that's kind of what we saw is, wait a minute, it's the ESOP has a lot of the same challenges potentially of private equity, where they're going to want you to stay. There are going to be contingencies before you're paid. And ESOP kind of has a similar structure to it. So I think um, the fact that you have to sell your business is a reality. So the question becomes, how do I want to sell it? Piecemeal to the private equity group? Do I want to sell it piecemeal to an internal employee where I'm the bank and you hope that employee actually does great? Or do I sell it to an ESOP and either way hand it off to a successor, or I stay on in that transition? And as the beauty of now, depending on what state you're in, as an ESOP, if you're 100% ESOP, no federal taxes, no state taxes. So now all that, I think of it as you have the same company making the same amount of money, but now instead of 30, 40, whatever, depending on where you are, city and state, going to the government, now that money can come back to you, and you can kind of almost pay yourself back through the performance of the company. So I think that's where and then and this is where our practice spends a lot of time in terms of tax strategy. There's a boatload of structures, especially if the plan is I'm going to stay on to run. I literally right before here was talking with a group, and they love the cultural aspect of an ESOP. We kind of talked about the altruistic piece, the what benefits the employees, but they're not going anywhere. They're in their 40s. They're going to be there for another 15 years. The way the ESOP could be structured, and this is written into the law to try to incentivize it, versus paying this massive capital gains bill because you sold your business, right? Think about it, you sell your business, you got to pay that tax, and because you sold it all in 1 year, you've got this massive lump tax bill at the highest tax bracket. The ESOP has got there's some pretty ingenious structures that you can set up to defer that tax and do a big chunk of it at capital gains.
Yep. And I think that, so let's talk through that a bit because, yeah, just since you bring it up, because I do want to come back to the altruistic side of it, right? Like, what are the benefits of this? But I think for business owners, like you are bringing up a lot of the tax elements of it that, you know, let's talk through the tax events that a business owner should consider, right? That, I mean, one, whenever you do sell your business, there is a capital gains tax to be had. And how does an ESOP, prevent that? Does there need to be any entity redesign or, new formation or like what has to happen to make sure, that ultimately as a part of, implementing this ESOP that the business owner can avoid capital gain taxes? Because for many business owners out there, again, to what John, just mentioned that, at least capital gains tax federally are not quite as high as the highest bracket of ordinary income tax, but still they're high enough that you don't need to be paying out 30% of the sale of your business to Uncle Sam, that, as much as possible, you'd like to keep those funds for your retirement, whatever you plan to do with it, whether you plan to reinvest that in another business, whatever the case is. So walk us through that. Like what needs is there something special that needs to happen as part of an ESOP implementation, or is it just the ESOP implementation itself that avoids capital gain tax? Walk us through that.
Yeah, I think it's some of it's written into the law and the way you can do these transactions. And again, without getting overly technical, think about it. Let's take the example of the 5 million. So you sold your business for 10 million, right? You're going to hit the top federal tax bracket. You're gonna, if you're depending what state you're in, all of a sudden you're gonna hit. If your state, some states don't consider capital gains as capital gains; they tax you at the ordinary income tax rate. So now you're paying taxes on that 10 million. Whereas in an ESOP transaction, you can actually spread that out because you can do the business sale installments. Let's say now you can bring that down to 1 million and we get paid out over a 10-year period, right? So now think about all the things you can do between charitable contributions, estate planning, what's your state of residency. Whoa, all of a sudden I live in Nevada or I'm in Florida now. Wow, you just got rid of your state. So there's quite a bit you can do because you can kind of control some of that in the transaction structure. And then there's, without getting overly technical, there's these things called warrants and synthetic equity. There are a couple other instruments, and we designed some pretty creative ones that have some tax advantages as well. So it's really that the ability to control the amount and the timing of your payback. And then depending on how you structure some of the more advanced pieces, especially if you're staying on, you can start to get some of the reward again much later. So you could, we see some transactions where the payback is structured inside of trusts. So you can start now building, a little bit better estate planning. So there's quite a lot of things that when you sell a business, that's it. If you're getting a check, you're getting a check, and so is Uncle Sam. I think ESOPs allow you a little bit of time, and then again, if you speak with a really good advisor, then some very creative. And like I said, I've spent the last 10 years designing some pretty creative. Can't really get into the details of it because they're proprietary, but there's quite a lot of advisors out there that can give you ideas on how to structure your ESOP correctly to maximize that tax.
I think that's the key for our audience, right? That at least one element I want them to take away is that sometimes they hear of an ESOP and they think, okay, like this is plug and play, this is what happens, or they hear of how a friend's ESOP was structured and okay, well, that's what has to happen. It's like, no, like there's many different ways that you can paint this. There are many flavors that you can implement. I mean, there's a grand structure of an ESOP, but you can do a 100% ESOP in terms of selling 100% of your equity stake to the ESOP. You sell 50%. Like you said, that the way that you get paid back, there's multiple ways that you can structure the financing for you to get paid back, and how long that payback period is. Whether there's some synthetic equity or kind of warrants or like big balloon payments that have to come in. Like there are so many different ways that you could skin the cat here, but ultimately the idea is that there is a deferral or a, potential reduction in total capital gains tax that can be, achieved here through going the ESOP route. I think another thing that, with a little bit of explanation here, John, and realizing I can't remember if there needs to be a entity redesign, or if there's a particular entity structure that is necessary to make this happen. But one of the pros of an ESOP too, right, is that, income going forward, once that ESOP is, and once that entity is an ESOP, income going forward, that ultimately you may not be liable for federal income tax going forward. And so, there's that premise of how do you finance the ESOP? Well, you can take out some debt or, however you finance it, but the cash flows that would have went to pay tax distributions can now go to finance debt or whatever, financing vehicle is put in place because you don't have federal income tax. Now, remind me though, is there a particular entity structure even underlying the ESOP, like in terms of filing, like S-Corp versus not, that you have to set up to achieve that?
Yeah, the most tax advantage is going to be an S-Corp. You run to people say, well, I'm an LLC, and really a pretty simple solution we did on a recent transaction is just the LLC becomes a disregarded entity under the S corp. So now you've got this new S corp. The ESOP transaction is going to flow through it. All your underlying, so you've got all your licensing and your insurance all in this LLC. It stays in the same LLC. Now the owner becomes the S corp that then is owned by the ESOP trust. So very very simple fix there to get the most. There's some practices sell all these other different, if you wanted to say a C corp, or there's these structures called 1042s that I find way too complicated. So I've never done those types of ESOP transactions, but those are another one to explore. I think the simple sub S, rolling whatever, and if any of these that aren't sub S, you roll them in under that new clean entity, and then you're off and running. And I think, as you were mentioning about the tax savings, so think about you're saving money on the taxes because you're not going to the federal government, so that can go to repayment. But then all the payments that you would normally, let's say you were taking $1 million distributions every year, you're paying federal income tax on that $1 million. Now that $1 million, since it's going through an ESOP transaction, that's capital gains. So you're having personal tax savings, is another piece there in terms of the pros of going the ESOP route.
I think for our audience, right, that even from a planning perspective, I would just, it takes a little bit to get settled into that reality that once you're an ESOP, that you don't have federal income tax, if you structure it, correctly. That I remember being years in, and it's like, okay, well, Trump's new tax bill came out, last year, and you think about, all the accelerated depreciation and all the effects, and it's like, well, none of that really matters, right?
Yeah.
That
Oh,
you're
yeah.
like, that, and so if you've been like so proactive in regards to your tax management, which is great, if you've been very proactive in regards to, okay, how do we defer taxes, that maybe as a construction business, we have had a great year, and maybe we need to go buy a piece of real estate for the owner separately, that, to take an owner's draw or distribution and then go buy a piece of real estate that we can go cost segregate that building, and then, accelerate depreciation and create a tax shield. That stuff, it goes away, that it just, and even for me, I think for our audience, like, to not have that world, it's a unique place to be, because, there's a beauty in it that, okay, you do have all the benefits now, but, how you think about planning, et cetera, it's going to be different ultimately, right? That,
Oh, no, it's so freeing. You're not thinking, yeah, you're that year-end scramble. Buy all the vehicles on December 30th. It's gone because there's nothing. You're not managing to a tax bracket. You frees you to just run the operation. How can I run a profitable business that cash flows? And I buy vehicles, or I buy an asset when it's needed or when it's a great deal, versus, I see companies getting themselves in troubles because they're just so desperate to get out of taxes. They're making foolish decisions. This is, it's a whole other universe. Like, you just, yep, file your returns, but at the end of that tax return, it says a big Fed zero.
and I think for our audience, I heard this put well once from an ESOP advisor, that because some of this might feel like it's too good to be true. But it made sense when I heard this perspective put into it, because when you think about it, there are a lot of aging business owners, gray hair out there, that, they call it the silver tsunami of, there's a variety of businesses that, with business owners that have no clear transition or exit plan of how they're going to exit their business and head into retirement. And so either they shut their doors, or there has to be an alternate route, of how do they eventually get out of their business. And there is hundreds of thousands of businesses like that throughout the United States. And when you're talking about that big of an economic movement of wealth, if it's not planned correctly, that can do some pretty drastic things and some negative things economically to the United States. And so, I heard it put well once, that because when you think about it, and I think this is where we can kind of dive into the altruistic side of it, John, where, um, you know, at the end of the day, there's a lot of these tax benefits for the business owners, but inherently you're granting stock to the employees that over time their stock will appreciate over time. And the premise being that, hey, you're kind of creating a retirement plan for them that they may have never funded in the first place. Because I think we'd all be actually surprised, maybe not, we wouldn't be surprised, but the amount of employees in the United States that actually physically fund a retirement plan is very slim. Like, you're talking about usually your top level middle management and up funds their retirement plans. Anybody below that, they aren't doing the 401k match. Like, they aren't taking advantage of it. And so, you kind of create this retirement plan for them that, you're funding employee stock for them that eventually they can liquidate and all that. But I think going back to it, that I heard that there's a lot of move in Congress for this because, in one aspect, the business owners want to avoid some of the tax. And so, there's arguments that, hey, lobbying for the sake of ESOPs because it is a tax deferral and some tax avoidance legally. Alternatively, a lot of the other camp of Congress that usually they would associate all that tax deferral with, the Republicans and everything. And then the other side of the aisle says, well, this is actually beautiful because, all of these employees that are low income, that they're now given a chance to actually fund a retirement and to create some wealth. And so it's an altruistic idea to it. Right. And so, if it sounds too good to be true, it isn't. There are these reasons why it's coming to be, audience. And so, that there are big reasons to it. So let's kind of dive in altruistically, John, that help our audience understand better about, what are the altruistic benefits that I talked about them lightly there, but like dive in, like, where does this go for the employees?
Yeah. So, and I think and when you get into it, I think this is where you're seeing this convergence of people, two different parties that have very different views economically joining hands. Because let's take the example that the company is worth $10 million, construction company. The alternative is they sell to a private equity is going to gut the company and basically run it from a mothership of 50 other $10 million companies, and now you're working for corporate America. Good luck. Got a new time card system, right? That's one alternative. The other alternative, which we've seen happen, is the owner's got nowhere to go and he just shuts it down because there's no one internally that can afford to buy him out. He's been killing it, right? You got a company worth $10 million. You've done well, and they just pack it up and they're on their boat, and now all of a sudden that entire group's off dispersed in the economy. Good luck trying to find a job, right? Those are really your two alternatives, right? Or you can say, no, wait, now I've created the structure. I've incentivized this owner to do this. And exactly that long-term benefit is now all these employees they still have their jobs, they're still getting paid. And instead of feeling the pressure to have to put money into their 401k, now as the company does well, they're getting shares every year that sits there until they're ready for retirement. And I think to me, that's just a fantastic way to kind of keep the legacy of your business if you don't have another alternative. Because of course, if you have another alternative, right, your son, you've got your executive team somehow can come up with $10 million, but it's not typical. So instead, now you've created this, and that's really where we do a lot of work in educating senior management team and individual employees to digitize and be able to see what that means. Because you could tell someone, oh, you got this new retirement, and unfortunately, it's not like your 401k where you can log onto an account and just kind of log in. You've got to do a little bit of work to help people understand, hey, long term, this is what it's going to look like for you. So I think it's a great, to me, if there aren't alternatives, I can't think of a better legacy. You've left, you're going to get paid, so and you can retain some control in that transition as you're selling, and being paid back. But now you set up the next generation, right? You're in your 50s or 60s, and you can't keep up going to the job site, can't keep, you know, whatever, ruffian construction work you're doing. It's nice now you've got this next group, and that's the other beauty of an ESOP. You can reward the employees, and then there's also the ability to create these synthetic equity rewards to retain that next group. So they might not have the capital to buy you out now, but you can design things that have, a retention aspect to it, to say, and that was part of in the company I worked for as an ESOP. We created these synthetic tools, and it was a great reward for us if we helped the company grow, but it was a payout over 7 years. So they got our whole executive team bought in, and we knew that, hey, we could leave at any point, but we'll get nothing. But if we do great, which we did do great, there was a pretty fantastic reward for us in year 7. So it was just a all around win-win. The owner's happy, he got paid. The employees are happy, they're getting shares. And it was just typical in a construction company. There's a core leadership team that's really driving the strategic movement of the company. That group also gets retained, right, which is important, and rewarded.
I think, I see a lot of these cases where, again, for companies that, you can look at the landscape of all the alternative options, right? Like you said, like you can go find a private equity buyer. I I'm totally fine putting this on record that um they are financial animals, right? And I'm not using the word animal. I'm just saying they're financial beings. You can call whatever the noun is. Um, they're going to be very focused on ROI. That may not be the worst thing in all situations, but if you've been a business owner that maybe you've done things that have been kind of unconventional, that maybe somebody, one of your employees, had a family member that got hurt, or maybe the employee got hurt and you went out of your way to take care of them, that's probably not going to continue in a private equity world, right? And if somebody's worked for you for 25 years and you I mean, if they've worked for you for 25 years and they've obtained a specialized job skill and skill set, uh, I'm just, and John, it's funny because for our audience, I tell everybody I'm originally from California. I left political correctness behind when I when I left California, right? But I I'm just objectively saying, right? Like it can be a difficult job market for somebody stepping out when they're 60 or 65 trying to go get a new job, right? And so all of a sudden, if you have these team members that, you're about to exit your company, and you bring in another buyer, you may be leaving them when they've worked for you for 30 years, without a plan forward. And, so for those business owners that really care about their people, yeah, an ESOP is an absolutely great option that hey, it allows your employees to build some wealth because they become employee owners, but you ultimately don't transfer the company to another buyer that would spit them up and chew them out, and gets to carry on the legacy of what you built. And so, yeah, it's for those reasons that's why honestly I think there's a lot of values oriented construction companies that they went out and they're committed to their community, they're committed to wanting to do things right for their people, and we see a lot of those, and that's why an ESOP is attractive beyond just the tax side of it, right? But an ESOP is attractive for those reasons. I'm interested because you've talked a little bit about this, and I think that's what I want our audience to walk away to is it's not just, oh, ESOP, 100% ESOP, seller's note, 100% seller's note, 10-year seller's note. Like that's the way that you structure this thing. There is a lot of flexibility, you all, in how you structure an ESOP. So kind of walk us through a little bit, at least from the financing perspective, because you've talked a little bit about this, John. Like, can you expand on, hey, like what are all the like alternative ways that you could set this up in terms of, total equity, financing, terms of the financing, how long it goes, like walk us through that.
Yeah, so, yeah, you mentioned kind of some of the alternatives, right? You could say, I don't wanna do 100%, I'm gonna do, a 50% ESOP and start doing it over chunks. So we have clients that are doing that. We've got clients that are doing want 100%, but the most of the deal is financed by a bank, and the seller held a little bit of a note. And I think there's pros and cons to each. It's one is if you're uncertain, it's a way to kinda, I'm thinking of the partial ESOP is one way to kinda dip your toe. My thought on the partial, you have all the pain of the ESOP without all the benefits, because all the we can get into the cons in another. There's a lot of administrative work, a lot of regulatory things that come into play. So now you've got all that in a partial ESOP, but you don't have the full tax benefit. Some of our clients have no choice. They're in an industry or in a state that there's some states that still don't recognize ESOPs, like in some engineering, architect, legal. It still has to be a human, because think about it, when you're an ESOP, it's owned by a trust now, and for licensing and insurance in some fields, some say I think most states are catching up. So there's some where you don't have a choice. You have to be partial ESOP for some licensing or regulatory issue. But my thought on a partial is you've got all the pain of an ESOP without all the benefits. I've yet to see, the only other reason I see people do that is out of fear. Like they think, oh, I want control, not realizing, remember, as a seller, you set the board, you hire the management team. So you're, and then as a if you're a seller finance, you have a lot of control in how you structure that loan agreement, so that you can direct. And that really is another purpose of doing the ESOP, is that you can direct that transition. You don't have to worry that the culture is going to go in a direction you didn't want it to, like the example of private equity or a new buyer that isn't related to the company, an outside buyer. So I think, that's kind of the pro and con of the partial piece. Then there's the banking versus seller. So the challenge of the bank is you're losing that deferral aspect because what's happening is the bank's paying you that money, so you kind of lose some of that benefit. The positive is you have if you're kind of sets a little bit about the confidence of the business. If you're a little bit worried, this is one way to get your money out quicker. So I like the control of 100% seller finance because you you get to manage the tax better. Also, it's less pressure because typically the way the deals I've seen, they're lump payouts with an agreement to pay out over time, so you don't have that pressure of a bank. The bank has a lot of control. They're not just going to lend you money. So it brings quite a bit of covenant reporting. So just the pros and cons there of saying, well, I'll do seller finance versus bank. Just be sure the bank's going to love it because they're going to great interest rate. They're going to get a bunch of fees. You want to make sure you weigh those though the pros and cons of seller finance versus bank finance.
We're gonna get in the cons next. I just for consideration to our audience, and you tell me, John. There are some banks that are ESOP positive, and then there's some that they don't touch them. And so I think you have to be prepared for that too. That um, in your financing structure that you may have to switch. Like if you've had an existing banking relationship for years, they may not be comfortable in their portfolio of just, being able to analyze and understand the ESOP. And so if they don't understand it, if it's a really small bank, and they can't wrap their mind around it, you may be looking at a new banking partner if you have to, get outside financing. But I think the key thing of this is you can structure this in a lot of ways that you can do, partial ESOP, you can do a full ESOP, you can do seller's note financing, you can structure how long the term of that is. You can decide, I want a 10-year note, I want a 15-year note, I want a 10-year note with a warrant, I want a 10-year note with low interest and a big warrant at the end. Like there are so many ways that you can do this. So it's not just that, hey, an ESOP out of a box audience that all of a sudden, this is the way you do it, that there's just so many flavors of this, that are possible. And I think you brought up a really good point, John, is that, for our audience that might be worried about, well, okay, maybe I do put in a seller's note. Um, again, the confidence level and what's going to happen in that business going forward is a serious question. But you put in a seller's note and you are banking on, that management team going forward being able to pay you back, right? You are banking on that. Granted, though, like you mentioned, as a seller, you don't actually have to leave the business. Like you get to institute your board, which means as a seller, you can be the chairman. Like you still get to direct what's going to happen for the next several years to make sure that payback option. So if you want to do seller's financing, and I think this is the key of it, you all, that an ESOP does not mean an immediate exit. That you're truly exiting your business, that even if you're not really ready to exit, but maybe you want to get chips off the table, that, hey, you'd like to get some liquidity out of your business and, begin to make that full exit plan for yourself personally, that you're not ready to let go of work yet, but you want to kind of go through this pattern. This is an option too. Like it's not just a clean cut and all of a sudden you got to figure out what to do with life.
And again, this is in terms of like in my mind, if there's doubts of the ongoing operation, you don't do an ESOP. So that to me, it seems like someone rushed into a transaction without, you're going to structure in a way where you're sure you're going to get paid. And just to kind of, in case folks don't understand what warrants mean. So the way you can do an ESOP where you sold the company, you've issued a note, but the ESOP law allows you to be awarded what's called a warrant. And basically what it is, it's additional shares. They're not in the ESOP. They're a synthetic equity. I'm trying to think of the best legal way to define it, but it's basically shares. So you sold 100% of the company, but you did some warrants and you retained 20% of the value. And it's a great way to say, hey, I think I'm selling the company at a great deal. So let's say you did a transaction, the company at $1, but you're sure the company's going to be worth $50. It's a great way, especially if you're going to stay on, to get that reward without burdening the company with a bunch of interest, because there's no interest expense on a warrant. You're getting paid on the appreciation. So it's another tool for so what I would suggest is, if you're sitting here as an owner of a construction business, you probably already know my kids are not interested, right? So that's one succession out of the way. you look at your management team and these guys are awesome, but they're not going to come up with $10 million. Right. So to my mind, if you've got an exit plan, I think starting really think of it as a decade long. If I was a construction owner in my 40s and 50s, I'd be thinking, hang on, I got another decade. Why not spend that decade running your business while you're getting paid back in a super tax efficient strategy? And now you're setting up the next generation to, let's say it's a 10-year journey to now they're often launched and they're debt free and they've got a decade of succession planning and training and pouring into it. So think of it that way. Think of it as you probably already know what the next level of management's availability to buy you out is. And if you've made up your mind, private equity is not, because they're sniffing around everywhere. They're gobbling up service providers because they've realized, like, I can buy these 10 HVAC subs, fire all their accounting, fire all their finance, because we do that at the mothership. So there's a reason they can squeeze out profits that you can't do it as an independent company. So if you know you're not going to go that route, I'd say start the conversations around ESOP, because I think you're leaving a ton of money on the table, and I'm allergic to paying taxes. So in my mind, I'd much rather have it than Uncle Sam. So I think you're talking years and years of tax payments that could be going in a totally different direction.
Yeah, and I think, again, I love that point that, I think people could be looking at this as like, this is the true exit in the sense of like, institute ESOP, I'm now no longer involved in my business. And what you just identified is that if you're getting up there in age and you do want to have a date at which you truly retire and go, and retirement may look like a variety of things to people, but you want, that there's a day that you don't want to be running the day to day of your business any further. You don't need to wait until that day happens to institute an ESOP, that you can institute it well ahead of time because of everything that John and I have talked about, that you can still run the business. It provides a lot of, tax benefits, et cetera, and you can still run the business. And over time, those employee shareholders that you can help, they're incentivized by being an employee shareholder, but you can institute, a lot of motivation and additional incentives to help them think about, how do I carry this business on? And you've kind of created your own exit plan that some of those employees, ultimately can, step in at some point, but, you're beginning that planning. But yeah, you don't have to wait until the final exit date to where you say, I no longer want to work in this business, that you can do that 5, 10, 15 years ahead of time ultimately. And so, yeah, I just appreciate this insight, John, that I know that there's just so much that we can go into. So I'm also excited to do our next, episode on the cons here. So, I think for our audience, just know that, John and I are going to do a next episode that will be released shortly after this on the cons of ESOPs. And, 2 45-minute episodes do not do this topic justice. There is a lot of nuance to ESOPs. There's a lot of things to craft out, but I think, John, I'm so grateful because I think you highlighted a lot of key points that a lot of people could be hearing of ESOPs, but I think the key takeaway is there's just a lot of flexibility to how these things can be structured. And I want to ask, is there anything that you would like to leave our audience with about the pros that they should consider, before we kind of step into the cons of ESOPs next?
No, I think we've covered quite a lot. I think, like I said, there's the beauty of it. There's a lot of information out there. There's a lot of associations. There's, unfortunately, like any business, tons of organizations that'll sell their version of ESOP, and us kind of, being more neutral arbiters in the space could hopefully give folks kind of guidance that I think that works best for what they're thinking. So I would say it feels complicated, but it really isn't. It really isn't. But it's just getting with the right advisors that'll hopefully guide you in the right path.
Absolutely. So, appreciate you, John. I appreciate everybody for listening in. Like I said, we're going to be diving in with John, for our next episode on the cons of ESOP. So, until then, we'll catch you next time, but appreciate you, John, here.
Thanks.
Awesome. Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message. And happy to chat and talk through anything you're facing today, and happy to provide some advice. So, thank you all. Appreciate it. See you.